Good afternoon and welcome to the East Bay Regional Park District's Finance Committee meeting on Wednesday, April 27th. Welcome everyone. There will be a time for public comments if you have them, and we have some new or continuing rules and regulations for folks' safety and in abidance with the Brown Act. And our staff will advise you of how to get in touch with us, and we welcome any comments you have. Staff, can you help me out?
Sure. Today's meeting is held pursuant to the Brown Act as amended by AB 361. Board members and staff may participate via phone, via video conferencing, and or hybrid in-person and remote attendance. We are providing video, live video and live streaming. Members of the public wishing to make a public comment can do so by this via Zoom, 2, by submitting an email, and 3, by leaving a voicemail. This information is noted on the agenda located on the Park District's website, www.ebparks.org. If there are no other questions about the meeting procedures, we can begin.
I think we need to have a roll call first. So
Correct. I'll start it again. This is Connie Swisher, recording secretary taking roll call. President and Chair Waspy.
Here.
Director Wieskamp.
Here.
Director Eccles.
Here.
And then our Assistant General Manager, Deborah Ocker, will introduce the Park District staff.
Good afternoon. I'm Deborah Ocker, the Assistant General Manager and CFO. And today our staff members with us are Michelle Strawson-O'Hara, Deborah Spalding, David Sumner, Christina Crosby, Matthew James, Ruby Tumber. We have Jeff Rasmussen, Tao Sepon, Von Sepon, and we have our General Counsel, Lynn Bargot, joining us today. I think I got everyone.
Great, and welcome to all. So our first item today, and I was pointed out that we have 2 items on today's agenda, and both of them are information items only, no action will be taken. So our first item is the fourth quarter 2021 General Fund and Other Governmental Funds financial reports. And Michelle, I think you're going to do that presentation?
Yes, thank you. Can everyone see my screen okay?
Yes.
Thank you. Good afternoon. Michelle Strawson-O'Hara, Assistant Finance Officer, and today I'm presenting the unaudited fourth quarter 2021 General Fund and Other Governmental Funds financial reports. I'll start off with an overview of the General Fund revenue and expenditures for 2021. The first column shows what we budgeted, including all budget adjustments during the year. And the second column shows actual revenue and expenditures through December 31st. You can see that overall actual revenues exceeded budget by 1.4% and actual expenditures were under budget by 9.8%. When we drill down on the details, which are found on attachment A or page 3 of your packet, the most significant dollar variances in revenues are related to property taxes, which exceed budget by 3.2 or 2%. And included in property taxes are the secured portion, which represent 92%, while the balance is primarily comprised of redevelopment agency pass-through funds, unsecured and supplemental taxes. Charges for services revenues exceeded projections as we budgeted concessionaire revenues very conservatively last year, but ended up having stronger revenues than anticipated, particularly from Gulf concessionaires. Investment earnings were less than projected by 1.1 million, primarily due to unrealized losses on investments net of realized gains. As a reminder, at year end, we adjust our investments to market value, which creates an unrealized gain or loss depending on the market. A gain loss does not become realized until the investment is actually sold. At December 31st, we recorded 3.4 million in unrealized losses and had realized gains of 1.1 million. Variances in expenditures relate to unexpended salaries and benefits, which were 9.5% under budget due to vacancies in several departments such as police and MAST. The district had been budgeting for 100% of authorized positions, regardless of whether they were filled. However, starting with the 2022 budget, a 4% vacancy rate was implemented. Supplies and services were also under budget due to unexpended fuel, program supplies, and repairs and maintenance supplies and services. Capital outlay appears under budget. However, there were encumbrances of $2 million for new fleet vehicles that were ordered in 2021 that will be delivered and put into service in 2022. If we look at the general fund revenue trends over the past 5 years, you can see the main source of revenue is property taxes, which represented 93% of actual revenues recorded in 2021. On the expenditure side, you'll see that salary and benefits are the main component and accounted for approximately 60% of the general fund expenditures for 2021. Next, we'll take a look at our unassigned general fund balance. So we started the year with $77.3 million. Then when we add in revenues of $173.7 million and subtract expenditures and other year-end closing adjustments of $182.9 million, we expect to have an estimated ending general fund balance of approximately $71.2 million. The district has a policy of reserving 32% of annual revenue to be used for emergency funding or other qualified circumstances. This year, the estimated target is $55.7 million, providing a $15.5 million increase to the general fund balance, which may be available to help reduce the Park District's long-term liabilities, such as pension obligations, and for replenishing reserves such as legal and election reserves. Attachment B on page 5 of your packet summarizes the other funds, special revenue funds, which include our Measure WW grants, Measure FF CFD, lighting and landscaping districts and zones of benefits, our project funds, which can vary significantly against budget due to the timing of project receipts. We also have our debt service funds and our internal service funds, which pay for the district-wide cost of workers' compensation, general liability insurance, major infrastructure and equipment, as well as employee benefit claims. Lastly, I'd like to just give you a brief update on our annual audit process. So staff from Brown Armstrong CPAs are currently conducting their final field work this week. While we're still preparing final closing entries for 2021 and preparing our annual comprehensive financial report, we do expect these unaudited results presented today to be consistent with the 2021 report. Given the financial report will be brought to you for approval at the June Finance Committee meeting, today's item is informational only. So that concludes my presentation. Does anyone have any follow-up questions? Or Deborah, perhaps you want to add on to some things I've said.
Yes, Michelle, that would be great. Would you mind going back to the slide with the detail of the revenues and expenditures? I just wanted to basically repeat what Michelle had said, that this is for the 2021 year, right? Last year's closeout. This is prior to us implementing new budgeting strategies. So you might recall with the 2022 budget, we did implement some changes that might help to reduce some of these variances by, as Michelle mentioned, adding a vacancy rate to the salaries and benefits, right? We did an analysis showing that we do have a, as most agencies have a regular vacancy rate, we implement 4% in that area. Also, we've really worked on our property tax targets, and we feel really strongly because our secured property tax was right on target here. Some of the variance is happening in areas that are very unpredictable, like redevelopment, dissolution revenues, and things like that, that we're still tracking, but we feel that the under 2% is a pretty strong is a pretty good target for our property tax. So I just wanted to thank the board for assisting us in implementing these changes. So in the next budget year, we will have a tighter budget going forward. And if we have any other questions on variances, we can drill down into those. Thank you.
Do any board members have any questions, comments?
No.
Member Eccles.
Yeah. Thank you, Deborah, for the, and well, thank you, Michelle and Deborah, but Deborah, you already answered most of my questions, but I am just sort of curious on the 4% vacancy rate. So if it had been in place in 2021, then so how much less of a net revenue would we be looking at?
So
I think our vacancy rate was around $5 million for this budget year. Is that correct, Deborah Spalding?
Yeah, that's right.
So it would reduce the variance by approximately $5 million. And then also I forgot to mention that when we did put the 2021 budget together, we tried very hard to kind of ignore COVID, but there certainly are things that were happening in 2021 that were affecting COVID. As we mentioned, our charges for services, we didn't put in expectations of 100% return to normal. And then on the expenditure side, you can see that we had savings in bus transportation because we didn't have programs. Some of the salary savings is just because we didn't bring our full amount of seasonal and summer staff that we normally bring in. We just couldn't, get them all started in time. So there were certainly COVID things that affected the spending on this year as well.
Great, thank you.
Mm-hmm.
And anything?
It's fine.
Okay. Just a question. So I guess the fun's over. I was wondering about that 4% vacancy and still having $11.1 million extra, but it's not applied until this year, which means the fund's really over. And I'm referring to, everybody knows, mid-year was so much fun because we would always have that vacancy rate and it would be there and we'd be able to spend it on one-time things, which really needed the cash. And it was great to be able to do that. But I guess are there any forecasts? Or I know you just said it's hard to forecast and it's difficult to forecast, but we're already through the first quarter of whatever year this is, 2022. So is there any indicators that looks one way or the other, or
Well, on the revenue side, property tax, as you heard in the news, are coming in as expected, strong assessed valuations. The counties are starting to put together their next year's projections, and they're looking, around 6% growth for the following future. So the revenue side is strong. I think we're expecting our normal summer with regular programming. We're all hopeful that that will happen. And then on the expenditure side, we have a great new HR team that is working so hard on getting all of the summer staff hired. And, they're just very busy doing recruitments. So we're hopeful that a lot of those new positions and any vacancies that come up during the year are able to be filled timely. We're working very hard at that. And with the new vacancy rate, that will definitely minimize the year-end savings or unspent funds for 2022. You're absolutely right, Director Waspy.
So, and this might be a political question. We don't have to answer it if we don't want to, but I'm kind of wondering if the predictions are that property tax will continue to go up and it'll look very rosy for us. Haven't we been in a position or I kind of got the feeling that a lot of people haven't paid rent for a couple of years now. And conversely, landlords are going, hey, what's going on here? And they've kind of been assured that, oh, don't worry, we're going to figure this out for you too. We're going to help you out, which tends to mean you wouldn't pay much property tax. I know that by statute we get ours, but is there any way the state of California could say, oh, well, this was a crisis and a worldwide pandemic, and by golly, we're going to lower people's property taxes because of this and because of all the emergency measures we took? That could any way legally anybody be able to do that to us?
Well, Director Waspy, as you know, the state has a lot of discretion and a lot of leverage, and they certainly could issue things like tax credits or things to try to mend losses of property owners. I personally haven't seen that in the news or in any legislation. Deb, I don't think you've read about anything like that either at this point. We're hoping that we're coming out of this, so maybe that time has passed where that would have been proposed, but you never know.
Okay, thank you. And then down on the fire department budgets and how they've spent money, they're only at 90% of their budget. That's unheard of in my world. I guess that means, I know there were not a lot of fires, but I know we were sent out of county a lot, and that costs a lot of money. I know the state claims they're going to pay up every whenever. I guess they have. Does that mean every out of county, well, you wouldn't know that, but I mean, does it sound like the state's getting around to paying on time for firefighters to go out of county and fight their fires for them?
On the expenditure side, this is just the general fund portion of the fire department expenditures. And as you know, our fire staff works a lot on fuels management grants. And so we can double check the spending there, but I think a lot of their expenditures are showing up against those grant funds and not here in the general fund.
Oh, okay.
And then on the reimbursement side, I do believe we have a really good program. The fire department staff is requesting reimbursement. Michelle, I don't know if your team has any information, but I think we are getting payments since this is a regular thing now. We're in the third or fourth year. I think it's a pretty regular system. Does that sound right, Michelle?
It does. In fact, I just reviewed a CAL FIRE reimbursement form just in the last 2 weeks that was submitted. Yes.
Fantastic. And I guess finally, grazing is down from 825K to 587K. Is that based on the drought or people not wanting to graze anymore?
Maybe Deb Spalding can give us a little information on how grazing works.
I don't have a specific answer for what happened last year. I can check into that for you. Yeah, it is something that's variable, and I know that the grazing staff are always very careful when they provide us with their estimate, and they couch it with, if the weather changes, it's really dependent on how much rainfall we get. I'm gonna say that I suspect it's due to the us not having a good rainfall last year that we didn't have as much grazing going on, so we didn't get as much revenue.
Okay. Thank you. There may be some members of the public here. Anybody have any other questions, comments from the public or staff or anyone? Seeing none on my big screen here, then thank you very, very much for your presentation, and thank you for your guidance in sailing the ship through rough seas and keeping us looking good. And we'll move to our next item, which is the East Bay Regional Park District Retirement Plan update from Deb Spalding.
All right, good afternoon, everyone. Deb Spalding, Assistant Finance Officer. I'm just gonna give you guys a short overview and some background on the East Bay Regional Park District Retirement Plan. And then I'm going to turn it over to our consultant who's here from Van Ewert and Associates, Mark Schulte. So hang on, let me get our slideshow underway. And can everyone see that all right? Okay. So some background on our East Bay Regional Park District retirement plans, which are sometimes known as the Transamerica plans. So before the Park District joined CalPERS, we had our own retirement plans. There was one for general employees and one for sworn employees. When we joined CalPERS, we closed those plans to new members. So they've been closed since 2000 for the sworn and 2001 for the general employees. And those plans were administered by Transamerica ever since then. So from like the 1960s until last year, when we conducted an RFP and we went out to see, were there other administrators who could help us manage these plans, especially since they were winding down. And we wanted to make sure we were providing the best service to our retirees. So last year we conducted that RFP and we transitioned from Transamerica to PARS. So we're going to stop calling it the Transamerica Plan, and we're just going to call it the East Bay Regional Park District Retirement Plan. So Mark will get into some more details, but these are closed plans. There are still 3 active members at the Park District, but it's really just winding down. So retirees and other beneficiaries are now receiving payments primarily from PARs, although there are some retirees who have annuities that were purchased, and so those continue to be paid from Transamerica. And if you have any questions on the background of the plans, I'm happy to take them. And then I want to hand it over to Mark from Van Ewerden, and he's going to give you the good news, which is the actuarial valuation, and also dive into some other details on the plan. I'll stop sharing. Does anyone have any questions before turning it over to Mark?
All right, thanks, Deb. Once again, Mark Schulte from Van Ewerden Associates, the actuary that works on your pension plans. And I've got a presentation here. I will share my screen. Everybody see that?
Fine.
Okay, excellent.
Yes.
Okay. So as Deb mentioned, we're going to talk about the East Bay plans, not your CalPERS plans. And we're going to just do a real brief discussion of the pension background, talk about plan accounting. It's going to be a key feature today is talk about the accounting calculations for your plan versus the funding, the long-term contributions for the plan, and then touch on a few additional issues at the end. So as Deb mentioned, we have 2 plans, the General Employees Plan and Sworn Safety, that have been closed for a couple of decades now. And on this slide, just am showing a summary of the participants remaining in each plan. And there's a heavy emphasis on retirees at this point. So a total among the 2 plans of just over 180 retirees and just a handful of active employees, and terminated vesteds are those that have a benefit that they've terminated employment but can receive that when they reach retirement age. So we call these very mature plans compared to an active pension plan where you will have many, many more active employees as members. And as I mentioned, we do 2 calculations for your plan. One is the GASB accounting calculations. These are really a snapshot based on the market value of assets at each year end, and those go in your financial statements. And then every 2 years, we calculate contribution budgets for the plans. And these are the funding calculations. And they're just different types of calculations. I'll talk about some of those details, but how I think about it is the GASB accounting is really a snapshot based on market value of assets. The funding calculations, we smooth out the investment returns over a 5-year period. And that's in order to keep the contributions at a more stable rate. Questions so far? So here, what we do behind the scenes is really, we're projecting out, we have all this data on your retirement plan population. We project out, what do we think the annual pension expenditures are going to be for these annuity benefits? And right now, both plans combined, they're paying out a little over $4 million a year. And because these are closed plans, we expect that to be relatively stable for a few years and then gradually trail off. But even for a mature plan like this, you know, we expect that these plans will be paying monthly benefits to the retirees for many decades still. So there's a long tail on a pension plan. If you were going to look at a plan that was open to new participants, it would have more of a bell-shaped curve to it. But here, we're kind of on the down slope. The red bars are the sworn safety plan, and then on top of those are the general employees. And this chart is one which it's always great to be the bearer of good news on pension plans, which is, you know, for a decade or so was not necessarily the case. And actuaries always had to bring, oh, your funded status isn't so great. These plans have really improved quite robustly the past few years. And these are the accounting results that are a snapshot based on market value. So I'll highlight here at January 1, 2022, that combined plan assets and liabilities, we are at 112% funded. So that's really a great ratio, especially when you consider that you were at about 56% only about 10 years ago. So the district's been really consistent in making the recommended contributions. So kudos to that. And then the past couple of years, you've really had quite outstanding investment returns, considering that your portfolio is generally a relatively conservative mix. So you've really benefited from both the consistent ongoing contributions and then also the above expected investment returns. And the last thing I'll also point out here is I caution employers not to get too excited about having, I hate to even use the word surplus, but I'll call it a funding cushion, because you need those cushions in order to guard against when inevitably investments might have a down period. So we don't want to necessarily spend the money. You want to build up a cushion so that then you can weather any future economic downturns and stay around that 100% funded level.
Thank you, Mark. Our investment advisors will appreciate you mentioning that the market does have its ups and downs.
Yeah, this past quarter is, I'm sure if we took a snapshot of the plan assets, they would not, you wouldn't be 112% funded, but you know, it's really remarkable the improvement that we've seen over the past few years. Okay. Moving on, this is just some numbers, and I'll try to highlight the important items. They're really details of what was shown on the prior slide. This is a comparison, so 2020 or December 31, 2020, though, a year ago, there was about a $9 million or a $900,000 slight surplus, about 101% funded. As I mentioned on the other page, now we have almost a $6 million funding cushion, 112% funded. And the real key on this page is the contributions. You know, we've been consistently putting in $2.5 million into these plans each year. And that really is a testament to being committed to a good funding policy. Any questions on these numbers? Nope. Okay. And then the last part, this is just a recap on the accounting on the investment returns. Where we like to look at this black dotted line is sort of the bogey. That's the expected investment return, right? Right now it's about 4.5%, 4.45% based on your portfolio. And we want to look at how far have you exceeded that bogey or have you fallen short? So even in years in 2016, you had a return that was greater than zero, but it was below the expected return. So that gives you an investment loss. But really the past few years, we have these 4 out of 5 years of substantial investment gains above expected that have really helped push up the funded status of the plans. Okay. Now we're going to kind of change tracks and move to funding. And as I mentioned, this is done biennially. So the last funding measurement was actually taken a year ago. We gathered assets and data as of January 1, 2021. So our next report will be a year from now. So these are a little dated, but they're for the budgets for your 2022 and 2023 plan years. So we gather the information, calculate the contributions so that you have them so you can budget 2 years ahead of time. And here, because there's a 2-year difference, you can see that there's a substantial improvement in the funded status from 74% on a funding basis up to 88%. And here I'm going to compare that to, well, how does that compare to our accounting results from a year ago? And there's a big difference here. And that difference is the smoothed assets. And it's this actuarial value of assets that smooths the investment returns over about a 5-year period. So if we jump back to this slide, all these investment gains are not yet being recognized. And it's all about having a moderation in how we recognize those costs so your contributions aren't volatile when we calculate them from year to year. So there's about a $6 million difference between the assets that are used, I should say more than a $7 million difference between the assets that are used for accounting and funding. But the positive aspect about that is when we go do the measurement at the end of this year, you're still going to be recognizing some of those investment gains. And so we expect this funded status to keep improving. It doesn't move around quite as much as the accounting part. It's just sort of a slow, gradual increase. And if you have poor returns, it's a slow, gradual decrease. Questions on that? Okay.
Deborah.
I have one question, Mark. So when people ask, what is your funded status? Is this the funded status we should be reporting or the market value snapshot that you showed before?
Wow, you pick the one that looks the best. No, it doesn't.
My gosh, an honest accountant here.
I would say that, long term, that what reflects the overall health of the plan is probably this funded status for funding purposes, because it's smoothing out the bumps in your investment returns. As I said, you were 112% funded 3-4 months ago, but that's probably quite a bit less than that right now. And so you're sort of, what is the funded status? I think this is a better measure of it. The funded status essentially smooths those returns out over a 5-year period.
Thank you.
Sure.
Member Eccles. Elizabeth, you're muted.
So sorry. Yeah. In terms of best practices for being funded, obviously 112.1%, if you use that number, that's a pretty good number. And even it seems 88.3% is a good number. But what for each of them, for either the actual or the funding status, the smoothed out funding status, where should we be? What is the recommended place for those percentages to be?
Recommended would be to get this funded status to 100%. That's your goal. You want to get there, realizing it's fleeting. It'll be a little volatile, but at least because it smooths things out, once you get to 100%, as long as you're consistently making contributions, and whether there's not a severe economic downturn, you should stay around that level. The accounting funded status, that's going to move around a bit. You're at 112. If you went up to 120, I'd say that's great. That's oftentimes we have employers that are looking at, I hate to use again the word surplus, I prefer funding cushion, but a surplus, and there's generally some policies out there of, well, we should spend that money. We have this surplus, let's spend it on the pensions. And that's really a dangerous trap to get into. And I would say, rule of thumb, not spending extra money on the pensions unless you're at least 120% funded, because you want to have that cushion. You just never know when the investments might not perform as expected.
Great, thank you.
And I'll agree with Mark, certainly for a closed plan like this, right? This is an obligation of the district that we've made a commitment to contribute these retirement benefits to these former employees. And we want to make sure, as the board always has really supported, making sure that we are responsibly funding these plans. I have heard from other actuaries, like Mark was saying, in a larger active, like a PERS plan, you don't need to be 100% because it just goes up and down so much that, sometimes when you're overfunded, we've gotten into trouble historically. So I would say 100% is a very good target for this plan. If we were to look at our whole PERS plan, I would be comfortable with it being less than that.
Right, and thank you. And also, Mark, I was wondering, so our annual investment returns, we're shooting for 4.45%, I guess it says. What does CalPERS shoot for, or say they're going to get?
Well, their current investment returns, they've been lowering it. So they were at 7.5 for a while, and they've been gradually moving down to 7. And now I believe they're going to 6.75. So, but it's tough to compare expected investment returns for two different plans because it's all based on what are you invested in. And CalPERS being an open plan, they have more equities, they're in private equity as well. So they have a more aggressive investment pattern. And they can do that because there's a lot of money coming in, having active employees putting in their own contributions plus the employer dollars. When you have a closed plan, you really have minimal to no employee contributions coming into the plan off a payroll. So you invest more conservatively. It's all about protecting that funded status. There's a concept in the pension arena, this intergenerational equity. In a perfect world, you would pay for these plans while they are still active members, accruing benefits. And then once the last one retires, you could turn off the spigot and it would just kind of run itself out for the next few decades. That's not necessarily what happens in real life, but that's the goal, is that you want these plans to be 100% funded when you get to a full retiree plan, So that requires minimal additional employer contributions, essentially because you're otherwise funding benefits for folks who are no longer providing services to the district. And the goal is when you're spending money on benefits, spend it on benefits for folks who are actually working for you. Kind of like in a defined contribution plan, you're putting money into the account when somebody's working, and then when they leave, they spend the money in retirement. Other questions? Okay. And one of the last slides here is just looking at the recommended contribution levels and comparing the 2018 and 2019 years was about 2.8 million with some favorable experience. The past couple of years been just under 2.5. And now we're recommending just around $2 million combined for the next 2 years. And this is often when employers will say, well, my funded status is looking pretty good. Why should I keep putting money in the plan? It's all about building up that cushion. You know, we already know that there's been a bit of a drop in the asset values because of the investment returns the first quarter this year. But these will gradually go down as the investment performance is recognized. I expect when we do the calculations next year that this could be substantially lower for the 2024 and 2025 plan years. Questions on the contribution rates? Okay. Really, the last slide is just some concepts we've talked about the past few years, managing this funded status so that once you achieve 100% funded status, that you're more likely to stay there. I think the district's done a great job of really moving to a more conservative investment policy, and that's a decision that was made years ago, kind of a gradual shifting from equities to fixed income and providing a little bit more stable returns. So that one's been in play for a while, and I think it's really worked out well. The funding policy adjustments, this is really just referring to the fact that there could be a substantial reduction in the budgeted contributions for the 2024 and 2025 plan years as you get closer to 100% funded. And then the options for streamlining the administration and financial reporting. A big step, I believe, was moving to PARs for the administration. From what we've seen so far, they've been doing a good job. We're looking forward to just getting a little bit more consistent reporting from them on our end, and anything we can do to make these plans work like well-oiled machines, the better.
All right.
That's the end of my presentation. Are there any other questions on the pension plans?
Any other questions, comments?
Good.
Deborah.
As always, Mark, I so appreciate your presentation, and you can explain all of this very dense material in such a great way. And since this is your world of retirement plans, I really value your kind of letting us know how we're doing compared to others out there, and the progress that we've made, highlighting the progress that we've made. So thank you. We've been working hard on this plan.
Yes, thank you. Excellent presentation.
Thank you. And congratulations everyone too for the improvements in the funded status. That just shows the dedication there's been over the past 10 years of consistently putting in the contributions. That there's one thing that's a downfall to a pension plan improving their funded status, it's not making the recommended contribution. So excellent work on that.
And as I mentioned, that is a board, supported policy. So yeah, we thank the board.
We listen to our accountant.
All right. Well, thank you very, very much, Mark. And thank you, staff, for a great presentation. And it's glad to see these. It's glad to see, because they're all my friends. These old dinosaurs are still going to be happy in their retirements. And I say that out of love and affection. Anyway, so moving right along, I think we'll move to public comments.
No public comments.
We have no public comments. Do we have any committee comments?
The public trusts our staff. Obviously, they don't even have to come.
That's it. No, Elizabeth. Okay.
I was just going to say, thank you to everybody. Good job. Good work.
Yeah, I was going to say the same thing. Thanks. It's fun being on this committee. You have to think more than the other ones, but it's enjoyable, and you guys make it. I won't say easy, but you make it. We can figure it out, and we thank you very much for that. So, gosh, there's nothing else, and I'm in
No.
Modesto.
This meeting we did, is a little shorter than normal finance committee meetings, so you can expect that your May 25th meeting will be back to a good handful of agenda items for you.
Oh,
Okay.
let us enjoy this feeling.
Enjoy the rest of the afternoon.
We look forward to that. Thank you all for being here. We are adjourned.
Thank
Take care.
you, Director Waspy. Thank
And
you.
Dennis?